Thanks for joining me this Friday, the 20th of September. I'm Grady market analyst with Bell Direct, and this is the weekly market update. This week we saw the first rate cut out of the US Fed this rate cycle in the form of a 50 basis point rate cut, taking the new range of the interest rate in the US to 4.75 to 5% for the next period, which was widely expected. In the past, the market would have responded positively to rate cuts of any kind. However, Wall Street fell on Wednesday after the Fed announced the rate cut as investors took hints of a potential recessionary environment to come out of the Fed's commentary. Fed Chair Jerome Powell signalled a second half a percentage point rate cut later this year, which investors took as a sign of economic weakness requiring eased monetary policy. The latest economic data out of the world's largest economy shows worrying signs of a sharp economic slowdown, with ISM manufacturing PMI for August rising less than expected, JOLTS job openings for July falling to 7.677 million when economists were expecting a rise of over 8 million new job openings, and retail sales fell to a rise of just 0.1% in August from a 1.1% rise in July. While there are some concerning signs in the latest economic data in the US, there were also key data in recent weeks that was released that signal economic stability in the US, including the unemployment rate falling to 4.2% in August, ISM Services PMI rising to 51.5 points, the core inflation rate remaining at 3.2%, while the overall inflation rate fell to 2.5%, and monthly PPI index rose 0.2% in August from a flat reading in July. Economic data and strength in the US economy will continue to pave the way for the Fed's rate outlook moving forward, but markets will likely respond with a rally over the near future as earnings potential and appreciation is on the horizon in a lower interest rate environment. The Fed's rate cut was welcomed by Aussie investors who pushed the local index to a record high at the open on Thursday this week. But why is the US rate cut positive for our local market? Well, firstly, a decrease in the US interest rate generally leads to the weakening of the greenback compared to the Australian dollar, making the cost of imports cheaper and the cost of purchasing Aussie goods more expensive for US companies. Secondly, a US rate cut boosts investor sentiment through increasing appetite for equities over safe haven investments like bonds, as equities offer higher returns in a lower interest rate environment due to the growth potential in the lower cost market. Lower interest rates in the US also increase local hopes of the RBA to announce rate cuts in the near future to align with the Fed's rate movements. Elsewhere this week, the price of oil is again at the forefront of headlines and impacting our local oil producer share prices. Escalating tensions in the Middle East and news of reduced oil demand out of China created a push-pull scenario for the oil price this week, signalling further volatility to come in the price of the commodity. China is the world's second largest importer of oil, and demand from the region has been declining for the last 4 months, only by ranges of 0.5% to 3%. Headlines of China moving away from oil and into a renewable energy market this week led to a sharp decline in the price of oil on fears of decreased demand moving forward, which is good news for Aussie drivers at the petrol pump, but bad news for our local oil producers, whose shares declined over the 4 trading days this week, including Beach Energy falling over 2% and Woodside falling 0.9%. The depreciation in the price of oil is unlikely to last, though, for 2 key reasons. Firstly, escalating tensions in the Middle East, the world's largest producing region of oil, are likely to not subside any time in the near future, thus placing further pressure on the price of oil. OPEC Plus is also likely to step in with further production cuts to stabilise the price of oil amid escalated volatility in 2024. Now let's look at the markets this week. Now locally, from Monday to Thursday, the ASX 200 rose to a record territory, boosted by the Fed's rate cut and positive economic data released locally. Over the 4 trading days, the ASX 200 rose 1.44%, led by Strike Energy rising 21.6%, while West African Resources added 18.4%. And on the losing end, Star Entertainment Group fell 10.89%, while Liontown Resources retreated 7% this week. On the broader market, the All Ords rose just under 1.5% this week, as Austral saw 36% 10% on new contract wins, while Next Egg Group fell 23%. Clients of Bell Direct this week bought into New Hope Corporation, Yancoal and Accent Group. Clients also took profits from WiseTech Global, Westpac, NAB, CBA, Qantas, ASX and Wesfarmers. And the most traded ETFs by our clients this week were led by BetaShares US Treasury 20+ year currency hedge ETF, BetaShares Australian Strong Bear Hedge Fund and SPDR S&P ASX 200 ETF. On the economic calendar next week, we will likely see investor reactions to the RBA's latest rate decision, which will be announced on Tuesday. Australia's monthly inflation data is also out on Wednesday next week, which will likely spur investor reaction, especially if the reading is higher than the 3.5% reported in July. Overseas, we will see key durable goods orders, GDP growth rate, and personal spending data out in the US, which will paint a clear picture of the economic health of the world's largest economy. And in China, we'll see key manufacturing data out later next week, which will give further insight into just how slow the economic recovery in the world's second largest economy is going post-pandemic. And that's all for this week. Have a fantastic Friday, a great weekend, and happy investing.